Hello everyone, welcome back to Fundrise Finance. With the stock market being in so much turmoil over the past year, many investors, old and new, would be thinking, why should we invest into the market at all? In fact, it's not wrong to think like that. We see the market down more than 25% year to date, and anyone would feel, why are we even investing? We are currently in a situation where inflation is at its highest in the last 4 decades. And believe it or not, stock market is an investing vehicle which can help us beat the inflation. When you look at the long-term chart of the S&P 500, we have seen quite a few downturns in the past. For example, the 2000 tech bubble burst, where we see the market dipping for almost 2 years before recovering a bit. And then the 2007 and 8 financial crisis, the market dipped the heaviest, but then they again recovered all the way. Then we saw a massive crash in early 2020 due to the COVID pandemic. After that, we saw a good run in the markets all the way till end of 2021. And right now, we are in another bear market downturn. So every time the market has gone down, it has bounced back. So in such uncertainty, where should one invest? In this video, we'll discuss 5 total market options, which in my opinion are the best vehicles to invest into and consider them as a core part of your portfolio. But before that, let's quickly discuss what does the stock market comprise of. To start with, we have the S&P 500, which is nothing but the top 500 companies in the US by market cap. So these are predominantly large caps and are considered the best in the market. Now, when you say large cap, it means a company whose market cap is more than $10 billion. Then we have S&P 400, which belong to the mid cap category. Now, mid caps are those companies whose market cap is between 2 billion and $10 billion. After that, we have S&P 600, which is comprised of the small caps, which are companies whose market cap is between $300 million and $2 billion. Now, aside from this, we have the Russell 1000, which consists of the top 1000 companies in the US by market cap. So these 1000 companies are split between large and the mid caps. And after that, we have the Russell 2000, which consists of small and micro caps. So micro caps are those companies whose market cap is less than $300 million. Together, these make up the Russell 3000. Now, with that discussed, let's check out the total market options which an investor can consider. The first total stock market ETF we look at is VTI. This ETF is from Vanguard and is the largest total stock market ETF we have. There's a very low expense ratio of just 0.03%. So for every $10,000 invested, you're paying $3 as an expense. You can see year to date it has fallen 23%. VTI tracks the CRISP US Total Market Index, and this ETF started in May of 2001. It invests across large, mid, and small caps and is passively managed, which means it strictly follows the index it is created on. VTI has 4,056 stocks in its portfolio and has $1.2 trillion in assets under management. Looking at the sector compositions, we see technology is the highest at 25.8%, followed by consumer discretionary at 14.8, followed by healthcare at 13.3, closely followed by industrials at 12.9, and then financials at 11.2. The top holdings are Apple, Microsoft, Amazon, Tesla, Google Class A, Google Class C, United Health, Berkshire Hathaway Class B, Johnson & Johnson, and ExxonMobil. The second total stock market ETF we see is ITOT from iShares. This is the iShares Core S&P Total US Stock Market ETF. Even this ETF is a very low expense one at just 0.03%. Year to date, it has fallen almost 25%. ITOT tracks the S&P Total Market Index and was founded in January of 2004, and it has over $37 billion in assets. ITOT has 3,359 holdings. Looking at the sector breakdown for this ETF, again we have information technology at 24.79%, followed by healthcare at 14.88, financials at 11.99, consumer discretionary at 11.27, and industrials at 9.02, followed by others. Holdings wise, we see the lineup same as what we saw in VTI before, with Apple leading at 5.89% of the weightage, and Microsoft, Amazon, Google, Tesla, Google Class C, Berkshire, United Health, Johnson & Johnson, and ExxonMobil. Comparing the portfolio composition of VTI with ITOT, what we see here is technology being the largest component of VTI at 25.8. In fact, information technology is also the highest one in ITOT, but it is slightly lesser at 24.79. Healthcare is the second position in IT/OT, whereas in VTI, healthcare is at third position at 13.3, because in second position comes the consumer discretionary sector at 14.8, which is in the fourth position in IT/OT at 11.27. So there are subtle differences between these two ETFs because they track different indexes. And not only that, the number of holdings in the ETF also matter, with VTI having 4,000 plus holdings and IT/OT holding close to 3,400 holdings. So that difference in holdings and indexes leads to these differences in the sector weightings. The third total market ETF we see is SCHB, which is a Schwab US Broad Market ETF that tracks the Dow Jones US Broad Stock Market Index. When this ETF has a very low expense ratio of just 0.03%, like VTI and IT/OT that we saw earlier. SCHB had its inception in November of 2009 and has almost 2,500 holdings. To a portfolio composition, information technology is the highest at almost 26%, followed by healthcare at 14.84, and financials at 11.58, and consumer discretionary at 10.57. So SCHB's composition is similar to IT/OT. So here we can see side-by-side comparison of SCHB and IT/OT. They are almost similar, much similar between SCHB and IT/OT than what we saw earlier between VTI and IT/OT. So IT is 25.81 and IT/OT is 24.79, followed by healthcare, financials, consumer discretionary. Yes, we see a slight swap between the last two sectors. In SCHB, utilities is at 3 and materials is at almost 2.9. Whereas here, materials is 2.8 and utilities is 2.81. And this similarity is seen even in the top 10 holdings. And this similarity is even seen in the top 10 holdings, where you see Apple, Microsoft, Amazon, Google, Tesla, Global Class C, Berkshire, Class B, United Health, Johnson Johnson, and ExxonMobil. So they're absolutely the same between SCHB and IT/OT. The fourth total stock market ETF we see is SPTM from State Street. This is the Spider Portfolio S&P 1500 Composite Stock Market ETF, which is also very less expensive, just 0.03%, similar to the three funds that we saw till now. Now, SPTM follows the S&P Composite 1500 Index, which is made up of 500 stocks in the S&P 500 Index, 400 stocks in the S&P Mid Cap, and 600 in the S&P Small Cap. I like the simplicity in this ETF composition. Now, S&P indices are very strictly maintained and tracked by S&P Global. So if a company has to be part of any of these indices, they have to make revenue. So they just can't be like your micro caps, which don't make revenue at all. This is the oldest ETF of all that we have seen till now, founded in October of 2000, and has just over 1,500 holdings. From a sector breakdown, we see information technology being the top at almost 25%, followed by healthcare at 14.77%, and financials at 11.7, consumer discretionary at 11.54. So this composition is similar to what we saw in IT/OT and SCHB earlier. The top 10 holdings being Apple, Microsoft, Amazon, Alphabet Class A, Tesla, Alphabet Class C, Berkshire Class B, United Health, Johnson& Johnson, and at last, ExxonMobil. The fifth and final total market ETF we will see is AVUS, that is the Vantes US Equity ETF. Now, AVUS is a relatively new ETF that started in September of 2019 and tracks the Russell 3000 index and has over 2,300 holdings. So if you look at the details of this ETF, it invests in a broad set of US companies, just like what we saw in all the four ETFs till now. But the difference that AVUS provides is it has a slight tilt towards active management. The four ETFs that we saw till now were completely passive, just tracking an index. But AVUS provides the ability to add value by making investment decisions using information in the current prices. They try to increase the expected returns by overweighting securities that they believe are trading at low valuations and with higher profitability ratios. We can see this style of management in the portfolio weightings. Here, information technology is just 20% compared to 25% in all other ETFs we saw. And energy is almost 10%. So, energy being the best sector this year, and likewise, information technology being the laggard. AVUS portfolio is tilted towards energy. So, that way, what AVUS does is basically build the portfolio towards a profitable sector and shuffle according to the market conditions. We see this difference also in the top 10 holdings, which is different from what we saw in all the four ETFs till now. Apple, Microsoft, and Amazon do make up the top holdings. But after that, we see a difference. Here we see Exxon and Johnson Johnson, which were typically in the ninth and 10th positions of all other ETFs. Then we have Alphabet Class A and Class C, and then Chevron, Merck, and Pfizer make an appearance. And also, the top 10 are not that heavy. In other total market ETFs, the top 10 typically comprise about 25% of the portfolio, whereas here, if we just eyeball the numbers, it's around 15%, which is actually good because no one company in the top 10 should be able to sway the performance of the entire ETF. So yeah, AVUS has a different approach towards the total market, and that shows in the performance, which we will soon see. Now that we have briefly discussed about all these five total market ETFs, let's see how they stack up against each other. Looking at the inception dates, here we see SPTM being the oldest, starting in October of 2000, followed by VDI in the May of 2001, followed by ITOT in Jan of 2004, followed by Schwab in the November of 2009, and finally AVUS starting in September of 2019. From expense ratio point of view, four of the five ETFs have the same expense ratio of 0.03%, and AVUS being highest at 0.15 is relatively higher because of it's slightly tilted towards the active management part of it. From assets under management, from the AUM point of view, which means the assets being managed by each of these ETFs, VDI is way ahead, having more than $1 trillion, followed by ITOT with $38.8 billion, followed by SCHB, almost half of ITOT at $18.91 billion, SPTM at $5.12 billion, and last, ABUS, $2.41 billion. Now, looking at the ETF grades from Seeking Alpha, here we can see from a momentum point of view, SPTM and ABUS have a B minus, followed by C plus for each of the other three. Expense wise, like we just saw, four of the five ETFs have 0.03% and have a A plus rating, while ABUS with slightly higher at 0.15 has A minus. Dividend wise, VDI has A minus, ATOT B plus, SCHB C plus, SPTM the highest at A, and AVUS at C. Risk wise, every one of them seems to be in the same grade at A, with AVUS at B plus, maybe because AVUS has a less lifetime to have that analysis. From the assets point of view, here we can see VDI being the highest, as we saw earlier at $1 trillion of assets, it's rated at A minus, while SPTM at 5.12 has a C plus rating. I think that's because Seeking Alpha may see that, okay, hey, in 22 years of its existence, it has $5 billion and has a C plus rating, whereas AVUS, having just slightly more than 3 years of existence, has $2.41 billion, so it has a A minus. From the dividends perspective, we see VTI at 1.74%, ITOT at 1.72, SCHB at 1.71, SPTM at 1.79, and AVUS finally at 1.63%. Now, mind you, these are total market ETFs. They are not meant for dividends. So always remember that from a total market ETF, you should expect dividends anywhere between the range of like 1.3 to 1.7 or 1.8%. Mostly it is between 1.3 and 1.5%, but because this year the market has been so low, the dividends have gone slightly higher. We can see that reflected in the 4-year average yield. Here you can see VTI at 1.6, ITOT 1.66, SCHB 1.69, and SPTM at 1.62. And AVUS has less than 4 years of existence, so obviously this value may not be correct. So you can see the dividend yield currently is higher than their 4-year average yield, courtesy the markets being down this year. Now, if looking at the 3-year and 5-year growth rates, we can see SPTM doing the best at 7.74%. Likewise, even the 5-year, SPTM outdoes the other three at 8.06%. And also, from consecutive years of dividend growth, SPTM has consistently raised for the last 6 years against 1 year for others. And all of these pay the dividends quarterly. From a performance point of view, it's obvious that this year has been so bad in the stock market that each of these is in the red. But relatively speaking, AVUS has done the best among these. We can see that reflecting in 1 month performance, 3 month performance of same gets reflected in 6 months, 9 months, year to date, and 1 year. The reason for that is AVUS is slightly actively managed. They look at sectors that can potentially do good. So currently we see in this year of 2022, energy sector being the best performer. And also the defensive sectors like healthcare and consumer staples doing better relatively. So AVS has tilted its portfolio composition towards energy, healthcare, and staples, and that reflects in the performance. But if you look at the remaining four ETFs, which are strictly index based, SPTM has done the best. Looking at year to date, it has done the best. Likewise for 1 year, same for 3 years, 5 years, and 10 years. Now, looking at the concentration and risk, we see VTI having the highest number of holdings, 4,000 plus, ITOT almost 3,400 holdings, SCHP just over 2,500 holdings, SPTM over 1,500, and ABUS almost 2,300. Concentration wise, in the top 10, VTI, ITOT, and SCHP are almost similar, the same range of 23.25 to 23.35%. SPTM is slightly higher, just over 25.3%, and ABUS the least in top 10, just over 16.5%. Turnover is same almost in all the ETFs, but SPTM being the least at just 1%. The more and more I look at how SPTM is composed, the more I like it. The reason being it avoids all those junk microcaps that are part of other ETFs, which are total market based. And even if VTI, ITOT, and SCHP have these microcaps, they're in such low part of those portfolios that won't even make a difference. So here, when we look at the year-to-date performance of all the five ETFs, we see the AVUS from Avantis doing the best, down just over 21%, followed by SPTM down 24.84, and the remaining three ETFs, which have more than 2,500 holdings, are down more than 26% for the year. Likewise, when you check the performance for the last 1 year, we see the same result. AVUS down over 17%, SPTM down more than 19%, and the remaining three down more than 22%. Here in this chart, where we see the performance of all these five ETFs, from the point of inception of AVUS, we see AVUS performing the best, delivering 31.73%, followed by SPTM giving 30 plus percent return, and VDI returning just over 24%. Now, just considering the four ETFs which have a larger lifespan, you're looking at a time range that is like 5 years. Again, SPTM delivers over here the best returns of over 56%, and VTI returning 48.5%. Even when we go 10 years back in time, from 2012 October till now, we see SPTM delivering the best returns of over 202% compared to 195% of VTI or 199% of ITOT or 194% of SCHB. Overall, I feel SPTM delivers. The more I look at the data, the more I feel confident about this ETF. It has a very simple composition of 1,500 stocks. It has S&P 500, the S&P 400 mid cap, and the S&P 600 small cap. That's it. Each of these is a revenue making company, which is what we want to see in our portfolio. With the Fed tightening its purses, there's no more free money in the market. People will invest money into those companies which make money themselves. And I feel SPTM is the right ETF for this moment. AVUS comes a close second. I like the active investing part of this ETF, which considers the sectors that have momentum. But this has a very short lifespan of just over 3 years. So it doesn't give enough confidence to see how it does in different market cycles. Oh yes, 2022 has given this ETF a good scenario to work with, and it has done wonderfully well. But is that enough? I'm really not sure. So that's the reason why I feel SPTM outdoes AVUS. Now, the investors' favorites like VTI have done well in the past, but just having 3,000 or 4,000 companies or holdings in their portfolios may just not be good. More numbers are not always good. Just having the feeling that my ETF will invest into the entire stock market of 4,000 plus companies may not be really good. We have to choose wisely, think forward, and invest accordingly. Hope you like this video. And I would really appreciate if you could hit on that like and subscribe buttons so that YouTube can suggest this video to many more people out there. And also, it would really be helpful if you could leave a comment with what you liked or disliked about this video. And that would really help me focus into my videos going forward. Thanks for watching, and until the next video, let's try to do as much as possible to be financially healthy. See ya. Bye.